The second video on understanding what are the kind of questions that will come up in a fund interview, the fund interview cheat sheet video number 2, is going to explore questions on three dimensions. So if you're preparing for an interview with a fund accounting firm or a mutual fund firm or even in investment banking, you got to have some bit of understanding of accounting, especially those graduates who've done an entire 3-year course or a 4-year course in accounting and economics must have a solid understanding of accounting principles, accounting practice, etc. You'll also be asked questions about economy and markets because they want to test you on how much do you know? What is your awareness level? Are you just logging into Zerodha app and then, ho gaya trade? No, no, no. What is your understanding? What's your fundamental understanding of concepts like inflation, understanding interest rates, etc.? And they will definitely ask you questions on the personal front for which many people often don't answer rightly. So you please prepare yourself for these personal questions. Whether it's women who get asked what are you going to do after getting married, or men who are going to be asked questions like are you going to study for after 2 years or 3 years. So then you've got to be prepared for a whole range of questions that could come up along these three pillars of accounting, economy and markets, as well as personal, when you go for an interview with an investment banking firm or a fund accounting firm. Question number 11. If you've missed out question number 1 to 10, then go back to cheat sheet video number 1 that has questions 1 to 10. We start from the 11th question. Difference between a hedge fund and a mutual fund. Here they want to test how sensitive is your knowledge about hedge funds and mutual funds. After all, you're making an application to a fund, right? So if you're applying for a position in a fund, you better know what is their job. And then if you're applying for a hedge fund accounting, you know that most of their clients are overseas, whereas in mutual fund, the clients are mostly domestic clients. So what are the differences that they have? You must have an understanding of these kind of distinctions between the two of them. Do remember to write in these points. Hedge fund has institutional investors, but mutual fund has retail investors. Now the question arises, what are institutional investors? Institutional investors are investors with large sums of money. Okay? Whereas mutual funds have small retail investors who do SIPs. It's not that they're small, matlab they're chota or they're tiny in size or something like that. It's just that their individual contributions could be as little as 1,000 rupees a month. Some of them even to SIPs of 1 lakh a month, depending on what is your faith and what is your belief in the mutual fund manager. Hedge fund charges performance-based fees in addition to management fees. What about mutual funds? They don't charge. They of course charge, but they charge a flat entry load and an exit load, or an exit load. So therefore, the hedge funds charge performance-based fees as well. Okay, and in terms of outperformance, you are typically having to pay the GP, the general partner, the excess of the outperformance that a fund has managed. Mutual funds have higher regulatory oversight. Please remember this. It does not mean that hedge funds are unregulated. I have often seen so many interviews where candidates have said that mutual funds are regulated, hedge funds are unregulated. That is totally wrong. Okay? Both of them are regulated. Okay, but who has a larger investor base? Obviously mutual funds, because they are partnering with retail investors. So the retail investors have a larger participation in the mutual funds, and therefore the level of disclosure, regulatory oversight is much higher. That doesn't mean you can have zero regulation for hedge funds. They have multiple regulations, but the level of disclosures from a hedge fund to the general public is much lesser compared to the mutual fund. So be very careful about the language you're using over here, okay? Because the interviewer wants to know how much you're understanding the business. Because if you don't understand the business, then you cannot be a very great employee. Okay. Question number 12. What is bank rate? This is a tricky one because straight away from hedge fund, mutual fund, we're going off to macroeconomics, all right? So remember, bank rate is a rate at which RBI lends money to other banks. Okay, over here I've used the term RBI for Reserve Bank of India. In other countries, it is their respective central banks. Bank rate is a monetary policy tool which is used by the central bank to affect the availability of capital. So if the central bank wants to control inflation, it will increase the bank rate. Am I right or am I wrong? Think about it. If there is inflation and interest rates are increased, okay, there's an era of economic price rise continuously, and this economic price rise is if it's an uncontrolled fashion, it's not really good for the economy. Central bank steps in and increases the bank rate to prevent the economy from overheating. Question number 13. Have you heard of the term OTC? Yeah, if you're a pharmaceutical expert, you would. But if you're a banking expert, you may or may not have heard of it. So, what is your understanding of OTC? OTC basically is a market which is very ambiguous. Okay? So, unlike a stock exchange which has a physical market, which has a physical building in place, it has employees, it has an existence, a structure, an infrastructure, IT infrastructure, everything. All that may or may not be so glaringly visible in the case of a OTC market. An OTC market is a market for structured and customized financial instruments. Okay? Over the counter market implies that both counterparts structure the settlement term. All right? This means that the products that are designed and customized by both counterparties will be as per the rules and regulations of those counterparties. There's no centralized trading place. So OTC is basically like a decentralized trading place. Examples of OTC, I always tell interview candidates that you give examples, because if you give examples, you are linking theory to reality. So rather than just being bookish and saying OTC market is, customized, structured, tailor-made, etc., you got to give an example. Where is OTC market? Give me an example of an OTC market. Is NSE an OTC market? Is Nasdaq an OTC market? Is Tokyo Stock Exchange an OTC market? And then you got to say no. The examples of OTC markets are bond markets and interbank FX markets. Even money markets are OTC markets, generally speaking. Are there different type of equities? So now I got this question because I was interviewing a couple of IT engineers for a banking company, and though their domain was largely in IT, as computers, they had understanding of how to trade in stocks. So they knew share bazaar very well, okay? But beyond share bazaar, they didn't know that there were different types of equities also. So can you name some? Yes, there are different types of equity. Equity means proportionate ownership. So whichever instrument gives ownership rights is an equity or an equity instrument. Equity instruments include common stock, preference shares, depository receipts, DVRs, that's differential voting rights. This varies on the basis of voting rights and participation rights. They vary on the basis of that. Question number 15. In accounting, we're going to accounting now. We use a term called fictitious assets. Can you elaborate? Now you heard of fiction, non-fiction, two different genres of books that you've read as a school kid, but now nobody reads. You only watch Netflix all night, and all the crazy docu-series that come up, or the mini series, the midi series, the maxi series that come up on different channels, and we're just spending all our time. So we know what's fiction and what's non-fiction. But in accounting also we use the term fictitious assets. What are they? Fictitious assets are assets that have no physical existence. That's also intangible assets. What's the difference? Fictitious assets also have no resale value and relate to expenses incurred in a particular year that can be amortized over a few years. Okay, example like when you start a company, you incur preliminary expenses to start up the company. Now that expense is registration of the firm, signing the memorandum of association, articles of association, getting together the business in place, are all examples of expenses that are non-recurring in nature. They are incurred at the time of starting the company. Therefore, those expenses can be amortized over a period of time. Hence, these are called as assets. But they are fictitious assets because they don't have any physical existence. And if you've taken a trademark logo or something like, you're not going to sell it off. So therefore, that also could be considered as a fictitious assets. When you're launching a new product like Apple goes on be launching every year. Apple iPhone 14, iPhone 15, iPhone 15x, iPhone 16, 16x, etc. I mean, they should just keep up with the times, right? I mean, in 2024, they should launch straight away Apple I-24 so that we can at least remember which year was the year of the launch. Promotional expenses are incurred with also are fictitious assets. Question number 16. Why is reconciliation so critical in accounting? In life generally also, huh? In life, generally speaking also, it's very good to do reconciliation. Need not be an accounting kind of a reconciliation, but even a day-to-day reconciliation of your expenses, incomes, assets, liabilities is a good idea because you have greater control of the assets and cash. Reconciliation is the process of comparing two sets of mirror-like accounts. Okay, for non-finance people, non-accounting people, reconciliation is a fairly elaborate process of matching my trades with your trades, or my books of accounts with the client's books of accounts, or investment banking books of trades with trading book with counterparty trading book, so that in case there is any mistake, it can be highlighted. Recon is a control function, very important. So the bank has greater control over cash and assets, and it's done at multiple levels in a hedge fund. Alright, it can be done between the hedge fund and the custodian, hedge fund and the counterparty, hedge fund and the client. All these are different types of recons that are done. Recon is a short form for reconciliation. 17. Difference between dormant and inactive accounts. Okay, this is a little regulatory kind of a question as to why we have different types of dormant accounts and inactive accounts. A dormant account, an inactive account is a bank account that has not been used for more than 12 months. This is the India context. A dormant account is one that has not been used for more than 24 months. And therefore, it's a measure of KYC procedure, that's know your customer procedure. Every bank has a very robust and strong system to put in place to find out the KYC and the AML, that's the anti-money laundering, to either reactivate the accounts or to close them, to prevent money from being laundered from the country. Okay, question number 18. Why is profit not classified as an asset on the balance sheet? Everybody thinks, no, I made trading profit. Like you have so many finfluencers, yeah, that pronunciation is so tricky. Finfluencers, yeah. We have so many influencers who keep on be showing every day that they make 1 crore, 2 crore, as if zeros have literally no value for them. Yeah. And then they put up and they say that, yeah, look, this is the asset that I'm creating with these profits. So for them, profit is an asset. But for a company, the profit is not classified as an asset. Do you know why? Yes, because profit is earned by the company which is belonging to the capital supplier. Over here, the shareholders who bear the risk of the capital. The shareholders therefore have a right over the company's profits, and liability means that the company owes it. Liability means that the company owes, asset means something that you own. So liability means that the company owes it to external parties. If you make a mistake, question number 19, private question. If you make a mistake in a large hedge fund, will you hide it from your seniors and get a scolding? Okay, hide it so that you won't get a scolding. Okay, what would you do? What do you do in life? Like if you make a mistake in the house, if instead of putting sugar in coffee, you put salt in the coffee, what would you do? Would you admit to the mistake that you've made, or would you say no, the salt just fell in, or the vessels were not marked properly, or the jars were interchanged? Sometimes we have a situation in the kitchen where the sugar jar and the salt jar got interchanged by a new cook or by a new maid. So then what would happen to you is that you would think, oh no, this is supposed to be sugar, but actually it turns out to be salt, and you go ahead and add it to your coffee. And when your father or mother taste it and they say, oh my God, who's ever tasted salty coffee? We've tasted all kinds of coffee, yeah, cappuccino, latte, filter coffee, degree coffee, whatever. But still, they all have sugar in it, or no sugar, but nobody puts salt in them. So then what do? Do you admit to the mistake, or you put the blame on the dishes and the maid and cook and etc.? And this question, better be prepared for it. What's the biggest weakness? Many people spend a lot of time not thinking about how they're going to answer this. They answer sometimes very briefly that my biggest weakness is I get upset very often. I lose hope very often. So then you have to also come back and ask, what do you mean by losing that? Uh, I remember one person told me that my biggest weakness is that I cannot let go. Okay, so you're, for example, in marketing or in sales, you keep trying with a particular customer because it's a large value customer, and you tried 4 meetings, 5 meetings, and there was no headway made by you. And then you just couldn't let go. You went on to the eighth meeting and the ninth meeting, hoping that you would be able to still convert that potential customer into an actual customer for the bank. So you have to understand what is it that they're looking for, so that you're able to give a justification of what is your biggest weakness. Next questions in video number 3. Thank you so much.